Nifty Bank was, okay, is it? Not really, is it? It's absolutely flat there as well. A bit of a divergent trend on Nifty Bank over the last 2 days as compared to the Nifty. So 55,200 on the Nifty Bank. Midcap index is 190 points in the green, 56,885. And you've got the small cap index, which is also coming up with gains about 0.25%, 37, 38 points, 17,650. 800 up, 400 lower. So that's the market breadth overall on the NSE. But it's just within the first minute of market that we're tracking. And that's the Nifty heat map. Bulk of everything is up in the green. 42 names are higher. One stock is unchanged, opening up just about. The others are low. But overwhelmingly positive, but nothing very large to begin the day. Prima.
Well, there's only one Nifty stock where the reaction is more than 1%. So things are quiet, at least on the large cap screen. Infosys is your top gainer, and that's got a gain of all of 1%. This is on the back of the company acquiring a 75% stake in a company in Australia, forming a joint venture. So it could add about 0.2, 0.3% to the company's top line. The street likes the acquisition. Stock is up nearly 1.25%. Some other IT names are also higher. Gains are not big, but you've got Wipro, Tech Mahindra opening up in the green. Some auto names, like a Maruti Suzuki, have a positive green tick. Eicher Motors, higher in trade. HDFC Life, Adani Enterprises, throw in a couple of pharma names like Cipla, Sun Pharma, stocks in the green. On the way down, you've got Reliance Industries retreating a bit, so that's exerting pressure. BEL, ONGC, Eternal are some of the other drags. But again, nothing too big on the way up in terms of a large cap reaction or on the way down. Infosys is the only one which stands out post that acquisition. Well,
that's right, Rima. From the broader markets, actually, there's plenty of action. Yatra, the stock is up 50% in this week. It comes in for some mild profit taking. So that one's up for you on the screen. HPL Engineering, that's up 25% for this week. Well, that's also mildly lower, down close to around 2.5%. Jain Irrigation, it saw a big spurt in the final few minutes of trade. They got an order, I think so, but the street has sold into that. Maybe the size of the order is not as much as what the street sniffed. The other one is HPCL, that as well is down close to around 2.5%. So keep that on your radar. The stock of the morning has to be Muthoot. In a few minutes from now, we'll have the management who will be joining in. And, things looked good out there. I've looked at the yields. They have moved up. The cost of borrowing is down. The growth has been good. Hard to fault those numbers, even X of those, of the one-off that we saw. The other ones that are actually not doing too well, Supriya Life, pull up that stock. I think it had moved close to around 5%. So Supriya Life, I think, is a little bit lower in today's trading session. Yes, it's down close to around 4.5%. Street didn't like those numbers. But there are other result reactions. Everest Kanto, stock is up 10%. Another stock that's been very, very flimsy from an investor perspective. Sometimes good, sometimes not so good. But that one is zooming away on large volumes. MIRC, as Nimesh told us, a couple of large investors coming in there. They are showing the faith. Remember, this is a stock that's half of what it was, if you look at it in the last 7 years or so. But big investors coming in there, they're showing in the money. The street is optimistic that could be a turnaround. So that one's, in fact, higher. And you have Jubilant Food as well as Bellrise, both of them doing rather well in this morning's trading session. So both of them up and about in trade today. A couple of other notable movers, I think so. We should get Genesis. That one has come in for some profit taking. The numbers look pretty okay. But the stock had run up in the last few days. So that's why that's come in for profit taking.
Okay, that's the screen for you right now as we open up trade. Let's invite Manishi Ray Chaudhary, CEO at Emor Capital Partners, joining us on the show. Manishi, thank you very much for joining in. The situation is changing every day, but as we speak, it's about a 50% tariff, which India is slapped with. But there is hope. 15th August speech from Prime Minister Modi. Let's see what happens in Alaska. I mean, what's your sense about the Indian markets, its current positioning right now with investors?
You talked about, first of all, I wish, my best wishes to your viewers and to yourselves for a very happy Independence Day. And, it's a delight to be here. So first of all, you mentioned the tariffs, but I think investors, and particularly the foreign investors, are more concerned about the earnings environment. As I've been saying, that consensus earnings estimates for India have been on a downtrend for almost a year now, since last September, and it's been across almost all sectors. So I think this earnings estimate downtrend has to stop. Earnings estimates have to bottom out and then begin moving. It's difficult to figure out
Okay, all right. I think we'll try to get Manishi back with us in just a bit. We're just having a bit of a technical snag out there, so we'll get Manishi back with us. Manishi, yes, I believe you're back. Go ahead and make your point.
Right. Great. Excellent. So, I think the impact of more cash in the hands of urban taxpayers and more money for the government workers, that should perhaps have an impact on on earnings, maybe in the later part of 2025, maybe in the fourth quarter and beyond. But investors would clearly like to see that happen before committing more capital. So, in a sense, India suffers from a relatively pedestrian micro, but at the same time, a great deal of macro stability with low current account and fiscal deficit, and now very low CPI inflation as well.
Manishi, you want to tell us how your Indian portfolio is positioned right now? What would your top bets be? And have you made any changes to your portfolio in the last 3 months?
Absolutely. So in India, so currently in the Asia ex-Japan context, we are currently neutral on India. And within India, there are possibly 3 pockets where we have a strong presence. First, the private sector banks. I've been harping on this theme for quite some time, that these are the banks that are likely to gain market share. Their asset quality is a lot better. Their technological capabilities are a lot better. Second, industrials, and that includes defense, though one has to be a bit selective here as a consequence of the high valuations that are prevailing. And third, consumer discretionaries, which is a combination of the automobiles, particularly four-wheelers, and other areas of discretionary consumption, which would also include healthcare services like, the diagnostics and the hospital chains. So these are the major areas, and 2 sectors that we are avoiding right now are consumer staples, where we think that single-digit growth going forward does not really justify the kind of valuations that they're trading at. And second, IT services, which we have completely taken out of our portfolio just about, I think 3 weeks ago. I think this, the reduction in manpower announcement by TCS is kind of a canary in the coal mine, which basically tells us about the kind of pressures from AI and, the lack of demand from the Western Hemisphere that this sector is likely to face.
Muthoot is locked up, guys, right?
Yeah.
2760 is where, that stock is at. What a move. I mean, that's the thing, right? I mean, stocks can frustrate you for a long time. And I remember this phase, stock did nothing for almost about 2 years, 2021 all the way to about 2024. Actually 2 years, 1400, 1500, 1400, 1500. And very quickly it's doubled. Similar thing with what the name, Nigel, you were mentioning, HBL Power.
Yeah.
6 months, 8 months, nothing, right? I mean, it's made a lot of money for investors from the lows, different sectors. But last 1 week, it's kind of more than made up for the underperformance. 25% very quickly, back at all-time highs. So, it's you got to be willing to sort of sit through phases of underperformance for stocks to work out. Anthem is another one. I don't know if you guys mentioned it. Anthem is up 7%. It's a recent listing from the CDMO space, but 805. Again, one of those names which has done phenomenally well. Anthem Biosciences. Pfizer is coming up with a 7% pop. It's got volumes on it as well. So 5,500 rupees on Pfizer, but it's got super gains. Premier Explosives went away home yesterday, limit up. It's got another 6.5% right now. So that's super, super strong. On the back of Muthoot, Manappuram is up 3.5% as well. So 265 on Manappuram. Bajaj Housing Finance. I think, Nigel, you were talking about this yesterday with a guest, right? 4% higher on Bajaj Housing, 113 on that one. And it's coming up with strong volumes as well. And out of the blue, there is Prime Focus, which is shooting up 8%. Prime Focus, $160. And the only reason I'm mentioning it is because it's got strong volumes behind it. So, 1,500 stocks are higher and about 900 stocks are lower at this point in time. Vari for the second day running is a top volume-led loser on the NSE. Vari is down about 3%, so keep an eye out on that one. And you've got a couple of other things which did extremely well yesterday, which are coming, seeing some profit booking. JM Financial did extremely well, and I think is down about 2% or so at this stage. Manishi, any thoughts on this entire CDMO or CRDMO, is whatever you want to call it, contract research development in the pharmaceutical space? Any stocks you like and valuations, risks to the business because of what's happening in the US? Your thoughts?
Right. Now, see, honestly, contract research, contract development, CDMO, these are possibly the themes of the day. And we're seeing this not just in India, but also in China. In fact, in China, it's the reverse. It's, the foreign companies, the overseas pharma majors, they're trying to license the drugs developed by the Chinese majors, right? So, I think China, in a sense, has reached this second or the third stage of development. India is possibly about 7 to 10 years behind. But broadly, I would think just like most other research outsourcing trend that we have seen, and we have seen in case of the GCCs, the Global Capability Centers, this is also a trend that's likely to remain alive in the Indian healthcare sector for the foreseeable time horizon. So it is something that, the investor would have to keep a focus on, apart from the usual generics that he plays in the Indian pharmaceutical sector. In fact, I would think that contract research, contract development would possibly be less at risk from the tariff and the trade dispute scenario than the generics would be.
Okay, all right. Thanks very much for joining us. Manishi, appreciate your time, and happy Independence Day, as you sort of began by telling us. Good speaking with you here on CNBC-TV18. Let's talk about the big story, the big stock, of course, which is making all the headlines, which is Muthoot Finance. Stock is up about 10%, limit up. There's an upgrade coming through as well. Morgan Stanley has upgraded their rating to an overweight call. Price target is now about 2,900 odd rupees. Loan growth is 42% for Muthoot. We have the management joining us now, as always, and we'll ask them if they now, after these results, want to upgrade their own assessment of what growth will be for the year. George Alexander Muthoot, welcome to the program. Thank you very much for joining us. So, we'll ask you what happened and what led to this super strong growth in the quarter. But let me ask you, do you want to, you've always said 15%, but we'll probably better it. You want to put a higher guidance number out now, Mr. Muthoot?
Thank you. Good morning. First of all, happy Independence Day to all of you. So, Prashant, I don't want to change the guidance now. We've always said the 15%. Give us a little time. So usually we change the guidance after second quarter. So give us a little time. But it will be definitely much better than what we said, 15%. There's no doubt about it.
So, yeah, 20% plus, right? More like? And in October, you'll do it.
Yeah, 15% plus is what I said. That is not limited to 20%. Can be even better. So we will discuss on it after the next quarter. Anyway, I'm also here next quarter.
No, I will not push you. But you said it yourself, sir. Could be 20% plus also for the full year, and why not? Looks like it. The numbers are very strong, but you will do it in the second quarter, along with the second quarter numbers when you report these, right? Yeah. So just a quick word on what happened in the quarter, what led to the very strong growth.
In the last 2-3 quarters, I think quite a few things have actually come into place. One of the things, as I've always been said, has been good demand for gold loan because of the overhang or the difficulty in getting unsecured loans everywhere. So that is one thing. The second was definitely the gold price and also the momentum about gold and about the talk of gold and people having gold and people using that to get. And the third and one of the important things was, again, the regulatory action which came by revised final guidelines. The final guidelines, if you ask me, has been quite good, and it is quite gold loan business friendly. When I say gold loan business friendly, it is helping the gold loan business not only for the customer but also for the NBFCs and the banks. So the regulations which came, it gave a boost to the regulatory overhang which was always there, was whether the finance ministry, whether the Reserve Bank is keen to promote the gold loan business. So I think from the regulations which came, the message I get is that the finance ministry and the Reserve Bank is keen to promote gold loan business, of course, in a very structured way. And most of the regulations, other than that, is mainly to give healthy growth to the system and also guidance to especially the new players who are coming into the gold loan sector. So overall, these combination of factors has been helping us in the last 2 quarters and last 2-3 quarters, and this quarter also the same thing helped a little more.
Record highs for the share price today. Mr. George Alexander, this is Rima here. What about your margins, your NIMs or your yields? It expanded by nearly 100 basis points in Q1. What led to that? Is it sustainable, or do you think coming Q2 we will see a decline in your yields?
See, the yield definitely, or yield always has been in the 18.5. The blended yield has always been 18.5. This time it is a little higher. The two things happened. One, we had the NPA write back or NPA decrease was about 700 crores, and the interest which was the accrued interest on that which has been coming into the P&L constitutes about 275 to 280, 300 crores. That is one. And number two, we had done an ARC about a year back, and all the capital has been received earlier. Now, what we received about 100 crores this quarter, just has gone to the P&L. That is the interest part. Probably another 100 crores should come in the next quarters also for the ARC, which is a facility we gave for the customers. Instead of auctioning the gold, we gave them time, and many of them were able to save their gold. That is the biggest advantage. Finally, we got our interest also. So these two factors increase the interest collection. There is a bump only for this year. So it's not that the yield would continue to remain in the 18.5. This quarter, it is 19.5. So that is just because of this extraordinary income which came.
All right. Hi, sir. Good morning. Good to see you in. When you see any kind of regulatory hurdles, it's actually proved to be the best time to go ahead and buy your stock. That's at least what evidence tells us, because that's the way the stock has recovered from the recent low that we saw earlier this year. That said, the numbers look good, and it seems like a blue sky scenario playing out. Yields are improving, cost of borrowing is going down. What are the NIMs we should work with from here on, if you could help us out with that? And we'll wait by to revise the growth guidance. But in terms of your gold and non-gold portfolio, what should the mix look like?
Our spread has always been 9.5, and probably this quarter there's a bump. I think we'll continue to maintain the spread at 9.5. So when you say the cost of fund, the cost of funds really has not started coming down because banks have not reduced their MCLR as yet. Probably this quarter and next quarter, they will be gradually reducing the MCLR, and our cost of funds may come down by 40-50 basis points. But having said that, if our cost of borrowing is coming down, we certainly will pass it on to the customer and reduce our yields also, but maintaining the spread at 9.5%. Now,
okay. The spread, the mix, sir? Mix?
The mix, yeah. So today, if you take out the microfinance portfolio, which is about 7,700 crores today, which was about 10,000 earlier, now it is only 7,700. All other, the personal loans, the home finance loans, etc., together constitute about 5,000 crores. So it's about 5% of the total portfolio, other than the microfinance. So overall, we would like to maintain, including the microfinance, today it's about 12 to 12%, maybe 15% of the portfolio should be in the non-gold sector.
Okay. By when, sir? By the end of this year itself?
No, see, if the gold business is growing very fast, our preference or priority will be to support the gold loan. And we are also building our non-gold portfolio, whether it is the home loan business or the personal loan business or the business loan business. So we are building that gradually. But gold loan, we are there always, and we will keep no stone unturned to see that the gold loan business does the best possible.
All right. So what about Belstar?
Belstar,
Now, Belstar has a couple of questions. How do you see the unit function going ahead? And I think you know the second part of the question is that the value unlocking. Will we see an IPO in FY26 itself?
Yeah, so the Belstar had a portfolio for 10,000 plus. Now it is about 7,000 plus. So in the last 2 quarters, they have been, should I say, they have been recalibrating the portfolio. And so the microfinance is coming down there. But it is stabilizing. I should see it's stabilizing after. This is Q2. After Q3, the business should stabilize, not only for Belstar, for everybody. But the recent regulations have got a good fillip to it, is that it said that 40% of the portfolio can be non-microfinance. So non-microfinance we can do, of course, because it is as a promoter's Muthoot Finance, we have certainly started doing gold loan. We opened 10 branches last quarter, and this quarter we plan to open another 50 branches exclusively for gold loan. So we will have a mix of gold loan and the microfinance in the Belstar. So going forward, it will give a little strength to the total balance sheet so that we have some sort of unsecured lending as well as the unsecured lending.
So in microfinance, and I think you did allude to last time we spoke, would you, from your perspective, say the worst is behind microfinance?
Yes, the first is behind because everybody has now started a little more, little more calculated and responsible lending. All the players have started.
But banks are willing to lend to MFIs, sir? Or is that a problem?
All the MFIs have started more responsible lending because everybody has...
No, I'm asking, are banks lending to MFIs to be able to lend?
I think so. For us, we are concerned. Our MFI is double A plus rated. So bank funding is not an issue for us. But of course, I also read in the papers that banks are not a little wary about lending to lower rated NBFCs. That I have read in the paper.
What about Belstar IPO, sir? You didn't clear the point on that. This year we're expecting it. You took me a little bit round, but you didn't tell me. Is it going to be in Q3, Q4? Should we brace for the IPO?
No, I think because now, as I said, the AUM is coming down. The AUM, which was about 10,000, has come down to 7,000. So, in fact, at this point, we don't need any extra funding. Probably it should be Q4 or next Q1.
Okay, but is it a AUM size that you're looking at? Say if it gets back to 10,000 crore.
It will depend on the growth we see in the microfinance. So, as I said, everybody is doing responsible microfinance lending. We also will be doing responsible microfinance lending. And at that point, if we need capital, we'll go to the market. I don't think it is that difficult even at that time to go to the market. So, at the moment, for next 2-3 quarters, I don't think IPO is necessary for Belstar.
Absolutely. Mr. Muthoot, 20% plus. You've given us a hint, a growth for the full year. But next quarter, at the end of the next quarter is when officially you will change the guidance.
It's not the 20% plus, it's definitely more than 15%. Not necessarily 20%. It can be even higher also. So let us keep it there. Let us not have a guidance.
So what was
let us keep it there.
What was the industry growth for gold loans, particularly in Q1? Yours was 40%.
Everybody is growing. All the banks are also growing their portfolio. The market is really improving. The total business of banks is about 13 lakh crores. And NBFCs is about 3 lakh crores. So banks have a much bigger portfolio.
And what a change it has been, right? We were talking about regulations 2 quarters back, restrictions on gold loans, and government is not too happy and all those kind of things. And it's completely turned on its head in terms of what is required and what needs to be done. There's a policy push as well as you alluded to.
I think it is mainly because this serves the community well.
Yes, absolutely,
People
sir.
have realized that
Absolutely.
it serves the community well. And I've been shouting from the rooftop that this is a small loan.
You have been. You
People
have been. As the
now-
oldest
now-
player, and I think we've been taking
Yeah,
that point
also understood
on.
it now.
Yeah, as the oldest player, we've been taking that point on board as well. Thank you very much for joining us. Great speaking with you. Really appreciate it. And good luck, sir. We'll speak again. Just a quick, maybe dip in on the JSW Cement listing. I think we have visuals, and Mr. Sajan Jindal is speaking at the NSE. And maybe for 30 seconds, we can kind of sort of dip in.
Group, and we can't be conservative. We have to be aggressive, and that's what India requires. India needs aggressive companies. India needs growth. So therefore, I hope that's what JSW will do. That, and I know that his mother Sangeeta has also always is very, very supportive and must be very proud. He's very proud to see him carry forward the values and with such strength and dedication. So she has been always a great strength, and so has been Anushri, who has always been on the side of Parth.
Well, I think Parth Jindal earlier spoke, and he said that it's a nice quote, if I want to live with my father, I better take this company to the #2 position. That's JSW Cement. So listing today, and I think we'll have more for you a little later. Nigel.
Well, and Parth is, to be fair, he's earned the position, right? Because when he came into JSW Cement, it was much smaller. Everyone said, father is such a great man, we need to listen to him. But he turned it from a loss-making entity into a profit-making entity, and he scaled it up substantially as well to 20 million tons. And over the last 10 years or so, whenever I've spoken to him, asking, where is it happening? And finally, that moment has arrived. Came in at peak valuation, JSW Cement, but it got lapped up. Investor interest was high. We'll have to see how they go from here. But getting to #2 is not going to be an easy task, because you have the Adani Group that's going to be at around 150 million tons. They're at 20 million tons, going to 40 million tons. Yeah. And Ultratech is at around 215 million tons.
So they're not even...
So what he told me is that we're the 9th player right now. Yeah. So we're price takers.
Yeah.
But the top 3 are very hard to move right now. They're giants. So our best bet right now, or goal, is to be the 5th player. I mean, that's the spot that we will be looking at.
Yeah,
but let's...
Fifth is realistic.
5th is what he's...
I think second will be a little bit tough. And as he said, right, earlier we didn't have, the bandwidth to go ahead and, in fact, bid for some of these assets. But now they're looking on to take on the Adanis as well as the Birlas. Well, let's focus on, we'll keep dipping in there. We'll get you the, I think the premium should be around 6-7 rupees or thereabouts with regard to the listing. So we'll wait by for that. Max Healthcare, that's the next company on the radar. Reported actually a steady performance. Occupancy growth was largely flat. Margins came under some pressure. International patient revenue, though, rose by close to around 32% on a year-on-year basis. We have Mr. Abhay Soy, the chairman and managing director, who joins us on the show. Hi, Abhay. Good to have you, and thanks a lot for joining in. Well, occupancy as well as ARPOB, both of them were flattish in the past quarter. Tell us what went on and what's the outlook on both these two parameters?
Well, as you know, we've expanded quite sort of dramatically over the last 15 months, and we've added about more than 30% capacity. In the last year alone, we've added 2 hospitals. One is Dwarka, which was a greenfield project, and which we commissioned in July. And we acquired JP Hospital in Noida. This was in October, November. So this is what I categorize as newer hospitals. So if I see existing hospitals, then you had an increase in EBITDA per bed. You had of about 7%. You had an increase in ARPOB of about 5%. There's been an expansion of margins as well from 25.8 to 26.2. But the 2 new existing hospitals are operating presently in the first year at about 12.5% EBITDA margins. And, they've sort of, as expected, would drag the overall ARPOB down, at least in the first couple of quarters. And as these ramp up, and that's exactly where the opportunity is, both the margins as well as profitability will expand from here on.
Mr. Soy, so the 2 new hospitals, Dwarka and Noida, you said margins are 12.5%. As they ramp up, say exit margins for these 2 hotels, what would it look like by the end of FY26?
Well, by the end of it, it should track at similar levels as the rest of the sort of portfolio that we have, because we only categorize hospitals. We have a fairly aggressive sort of this thing. We categorize only hospitals which are 12 months old as new hospitals. So yeah, by the end of the year, they should be ramping up closer to the rest of the group.
Okay. And international patients growth really picked up for you. Very strong traction seen, up 32% revenue growth from international patients, 9% of your revenues. What led to the pickup and what can you guide here?
Well, we normally don't give a guidance, but if history is anything to go by, I think last few quarters we've been growing at more than 25%. Yes, it's been more than 30% this quarter, but 25 to 30% seems like a decent sort of growth rate that we've been sort of getting in the past, and I don't see any reason for that not to sort of continue.
Abhay, hi, good morning. So as a percentage share, Abhay, you want to leave us with a number? Where do you see it by the end of the year?
Well, it's presently 9% of revenues, and why I stay away from percentage share is because we also dramatically increasing capacity, as you're aware. So, if our capacity goes up is expected to go up by 30% in the next 6 months before the end of the year. And that should actually bring down the total share, because if your capacity is going up by 30%, and let's say if your international business is growing by about 25 to 30%, then it should marginally reduce, go up, or remain the same. But, apples to apples, it would grow otherwise.
Max at Home, which is your home healthcare business, and Max Labs, the diagnostic business. Could you give us an indication of how they're likely to perform in the balance 9 months, and even on margins picking up for Max Lab? I think currently it's about 13%.
Well, we've been investing for growth in these businesses. They've been consistently growing at 20% plus for, I think, many, many quarters now and for many years. And I see that sort of keep expanding. I see the margins, of course, grow in the lab business closer to where the peers are. The home care business gives more than 20% margins, so we're quite sort of healthy margins. These are low return or very high return on capital because there's hardly any capital required. At least for the labs, we use our own labs at the back end, the spare capacity in our labs and so on. So this should ramp up pretty well. But yes, I think, even whilst the rest of the sort of sector, a couple of years back was kind of dipping, but we've soldiered on. We've seen similar sort of revenue growth, which is 20% plus.
So for Max Lab, these are the steady state margins, 13%, assuming the 20% revenue run rate continues?
No, so like I mentioned, this should move up. They should move up to 17%, then 20%, and so on. So I see this going up. There's no reason for it to kind of remain at 30. As we sort of keep investing, so long as you keep building critical mass, and when you invest is a smaller component of what you have on the ground, you're going to see margins grow. Because when you set up new points initially, like I mentioned, margins will suppress, but that's investment for growth.
Is there any inorganic growth, Abhay, that you're looking at?
Well, these are very high value, very sophisticated sort of labs that we run. So you must keep in mind that all of the high-end work we do, all the super specialty work that we do at our hospitals, all our senior clinicians rely on the efficacy and efficiency of our labs. And so you have to find sort of similar sort of quality labs out there for us to sort of do bolt-on acquisitions. That is something we always look forward to. They tend to be far and few, but of course, when the opportunity arises, we're quite open to it.
Just one last question on the international patients, Abhay. Before 2019, did not just you, but I mean hospitals, were Chinese patients a big did they make a meaningful number of international patients seeking treatment in India, or not really?
No, never. So actually, I don't think that Chinese patients do come to India. They have a fairly robust government hospital sector, which the public hospitals over there, also parts of them do private work. But most Chinese people go to government hospitals. They have a far bigger reliance over there on government hospitals. So China has never really been a source of patients. Having said that, I think, we are seeing now also influx of patients from developed countries. Earlier you were seeing them from the Middle Eastern cluster, the African cluster, the SAARC countries, the Eastern European cluster, where it was self-pay. It's not necessarily patients which were sponsored by the government or by the insurance in their countries. But now, given the huge waiting lists over there, we are seeing some early signs of patients. And India really, I think, being able to tap its comparative advantage as far as healthcare is concerned.
Abhay, we'll leave it there. Thank you very much. Good luck with the business. Appreciate you joining us here, as always, on CNBC-TV18. Thank you. Markets are down. Markets are up 38 points, 40 points, off the highs a little bit, 24,657. I just want to make a mention of 2 or 3 names maybe. CSB Bank is down 8%. That's a large cut coming through, $350 on CSB Bank. Sami Hotels, actually we've spoken with all these companies. Sami is down 4%. It's coming through again with a large cut. There is HPL Electric, which is down 11%. That's a very large cut coming through on HP Electric. And Deepak Nitrite is down about 4% as well. Actually, if you look at the advanced decline, it's kind of flipped, more down than up if you look at the all NSE list at this point in time. And many more new names into the mix, which we will address in a bit from now. Take a break. NHPC management on the other side with their first quarter performance.
Well, let's focus on NHPC. The stock is a little bit lower, I think, in trade in reaction to its Q1 numbers. The margins disappointed, but revenue saw a growth, with the power generation also double-digit growth. We have with us Mr. Goel, the Chairman, Managing Director, and the Director of Finance who joins us on the show. Hi, Mr. Goel. Thanks a lot for joining in. Well, in the first quarter, we saw 11% generation growth. For the year, what kind of a growth are you seeing? And how is the overall demand-supply scenario panning out right now?
Since we have commenced our Parvati 2 in current year, and there is increase in generation of Parvati 3 also, and we have already commissioned 214 megawatt of big solar project. So we are seeing a growth of around 15% in the generation in current financial year, and the similar growth will be in the revenue and PAT also.
Parvati sir, how many units have been commissioned? When do we see the entire, the entire facility, all the units getting commissioned? If you could tell us, and what kind of contribution can it give to your numbers?
We have commissioned 3 units of Parvati 2 on 1st of April 2055, and balance 1 unit has been commissioned on 16th of April. So all the 4 units with 800 megawatt has already been commissioned, and it is generating very well.
What is the expected contribution, sir, from Parvati for FY26?
For FY26, we are expecting around 500 crore of PAT in current financial year.
Okay. And for Subhanchari, when can we, you've got 3 units which you plan commissioning. When will that happen?
We are ready for commissioning with 3 units as of now. But due to pending clearance from the NDSA, we are likely to commission 4 units in the first week of October 2025, and balance 5th unit will be commissioned in January 26. So during current financial, we will commission 5 units with 1250 megawatt of capacity, and balance 3 units will be commissioned in the coming financial year, one by one.
The National Dam Safety Authority, the NDSA, visited the project to review plans. Have there been any demands, any cost escalations, any upgrades you need to do here before you commission these?
NDSA visited in the month of May, and they have given certain tasks to be completed before commissioning. So we are working on those items which have negligible cost, but it will be completed in September month itself, and we are expecting visit of NDSA in the month of August itself. So we are very sure to commission this project in the month of October 2025.
No, got that. You established a dedicated, a renewable energy arm, NHPC Renewable Energy Limited, NREL.
Yes, you are right.
What's happening there, and what is the plan? I think you indicated some separate listing as well.
No. There is no plan to list this company because the capacity is yet to come in this company. Basically, we are a hydro company, and we are focusing on hydro, particularly after this IWT suspension. So we are doing little bit in solar and wind, but we are doing solar business in NHPC itself, holding company itself, and we are doing the work in RIA mode.
Sorry, what is NREL going to do then, sir? Because this is renewable itself, right?
Yes, it is also renewable, but hydro is also very much renewable, and we are focusing on hydro more.
Right. No. So what will NREL do?
NREL will do solar projects in future, depending upon the viability and considering the return on equity at least 12%. Otherwise, we will not do solar project below that 12% return on equity.
Right. Got that. So nothing really firmed up. I mean, it's you'll do it if it's viable, as you said.
Yes.
Okay. Now, capex target for the year stands at about 13,000 crores. It's about 13% higher year on year. Could you give us a sense of how much has been spent?
Yes.
And is there any change to it?
Last year, we incurred 11,600 crore as capex, and for current year, it is 13,000 crore. We have already incurred 3,700 crore up to, and in the first quarter, it remains at lower side because of monsoon. But in the coming period, we are very much hopeful to achieve the target of 30,000 crore.
Have you set a long-term 5-year capex target, sir?
Yes. We have capex target for next 10 years, and it is in the range of 13,000 to 15,000 crore annually. During current year, we are going to float tenders of around 5,500 megawatt capacity in hydro, considering Sawalkot 760 megawatt, Kamla 1620 megawatt, Subansiri Upper again 1800 megawatt. We have already floated tender for Durasti Stage 2 and Uriban Stage 2, taking together capacity of these two projects 600 megawatt. So our capex is very robust, and the coming decade is for hydro only, because renewable is coming in big way, and to support the grid, hydro is must.
Okay, we leave the conversation here. Thank you very much for joining in. ICICI Bank, by the way, had opened in the red and now is back in the green. It's got a gain of close to about 0.5%. So following the customer feedback, remember, they've lowered the minimum account balance to 15,000 rupees. The stock has moved up. Infosys continues to be the top Nifty mover, 1.5% up. Mitesh is now with us. Mitesh, quiet start, but it's got a positive tilt, at least the Nifty and the Sensex.
Yeah, I think, the Bank Nifty is doing well today. And as you were highlighting, I think a couple of IT names have, also supported the index. So in fact, on the trading side as well, I have a buy on LTIM. Keep a stop just below today's low of 5127. So 5125 is what I recommend. I think we could see a reversal here, which could see the stock head towards 5260 plus levels. The other one is again from the IT name, that's HCL Tech. Here I would recommend buying once it starts getting past 1510. We got a high of around 1507 today. So buy about 1510, keep a stop at about 1490, look for targets of around 1550.
Any view on Reliance Industries?
See, Reliance, has gone through a big decline, and there is a pivot around these levels of 1360. It's been holding on to that level for last 4 or 5 sessions. If you go back to the last week's price movement, it bounced back around this 1360 level. So as long as that is holding, good chance that we'll see a bounce back to about levels of 1420. Above that, the trend will reverse on the positive side.
Okay, all right. Thanks a lot for that, Mitesh. Well, those are the visuals that are coming in there from the NSE. Mr. Parth Jindal out there, Southern Jindal, the little girl out there, family member as cute as ever. And Mr. Rao is there, Mr. Sheshagri Rao as well, that's been instrumental in building the JSW group as well, has made it, and Mr. Ashish Chavan as well of the NSE. So the bell is rung. The stock lists at a mild premium in comparison to what the IPO price was at around 147. Valuations are not cheap. The street is looking ahead from 20 million tons. Parth wants to take it to around 40 million tons. He wants to be a larger cement player. And he said he'd rather build than buy. That's been the motto. And he's expecting a big turnaround here for the company as well. Debt goes down as well. Interesting to see how things pan out. Not cheap, but for the time being, opens in the green. That little baby out there, that's the one that catches my eye.
And there's Parth's daughter there, which is, and I spotted the CEO of the business, JSW Cement, Nilesh Narvekar.
Yeah, he's there.
He's there.
I mean, he's along there with the entire team next to Mr. Rao. So yeah, absolutely, and it's a momentous occasion. One more Jindal group. As far as the listed space is concerned, and one more cement company for Nigel to track. So 154, about 5% higher, and look at the volumes coming up. That's basically photo ops now. More in terms of valuation comparison, etc., through the course of the day as we go along. But for now, we'll take a quick commercial break here. Manisha is going to be with us to run us through the commodity action that she's watching.
Welcome back. Midcaps is slipping a bit. It's down 250 points in the midcap index, so 0.5% lower. You've got visible cuts coming through in HPL Electric. CSB Bank is under pressure. NMDC is weak. Brigade Enterprises, EIL, Max Healthcare. We just chatted with the management. Yatra Online. These are some of the stocks which are weak in trade. But let's talk about commodities. Manisha is now joining in. Manisha, what's the one commodity you're tracking today?
Well, I'm looking at a data really, Rima, because this is interesting. We all have been talking about on how so many sectors will be impacted with the kind of tariffs that US has put in. And gem and jewelry sector clearly is on the top two there. When you look at the numbers, well, nearly 30 to 35% of our gem and jewelry exports go to US. And interestingly, the data for the month of July has come in, and that shows that the exports from India for various gems and jewelry actually has been surging ahead of those tariff expectations. So when you look at the month of July, we've seen rough diamond exports gain up by 32%. Polished stone was up 22%, and that is a surprise that you have in the last number. 83% of a jump on a month-on-month basis. This is what we've seen in sense of lab-grown diamond exports. These export numbers are to various countries, including US and UK and UAE as well. And we're looking at very strong numbers there. So when you look at the overall exports, those gained up by 15 or 16%, and imports were higher at around 26.5% as well. So very strong numbers in July. August, of course, is a bit of a question mark with 25% tariffs already on, and we're looking at or staring at 50% by the time it's 27th of August. What the street also is looking at very strong numbers in sense of cut and polished diamond. Those exports were up by 18%. You have polished lab-grown diamonds up 27%. Gold jewelry also saw some gains with nearly 17% of a jump up coming in for that. And then you have platinum jewelry, which also gained up by nearly 14%. What did not do so well was colored gemstones, just about a 2% of gain. And silver jewelry exports actually declined 2.5%. So clearly, more people bent towards gold and diamonds with those prices rising, and not so much for silver there. The buyers clearly seem to be stocking ahead of those tariffs is the narrative that comes in from these July numbers. 25% tariffs already on, and we do understand from various exporters within the sector that the trade is quite at standstill because the margins in jewelry are at about 1 or 2 and maximum 4%. 25% is something that they can't absorb, and 50% they tell us is a non-starter. If that comes in, then there is going to be serious trouble coming in for the industry. Also, when you look at the previous financial year, we saw $13.2 billion worth of Indian exports when it comes to cut and polished gems. Out of that, $4.8 billion were just to US. So very strong numbers is what we're looking at. But whether or not August can continue or what is the kind of numbers that we will see, that would come in about in next fortnight or so.
Right. Thanks very much, Manisha, for that. Keep an eye out on headlines coming out over the next 24 hours. Will be consequential for commodities, definitely oil in particular, but others as well. Market breadth is now decisively turned. About 1,500 stocks are lower and about 1,100 stocks are higher right now. That's the market breadth. And, NMDC is the number one volume-led loser. But there is Garden Reach Shipbuilders, which is down 3%. Yatra is down about 3.5%. HPCL is down 3%. KRBL, Deepak Nitrite. It's a whole list of companies there. HPL Electric, I mentioned earlier, it was down 10%. It's down almost 13% at this point. CSB Bank is down 7%. So that's a very sharp cut coming through. SAMI, I mentioned earlier. So many actually names which are coming through. EIL is down 3.5%. Aarti Pharma has had a tough week. This one, about 4% lower. SPML Infra, 3.5% down. And all these, by the way, got volumes. Oh, dear. Look at Surya Roshni. Surya Roshni is down 7.5%. And it's just completely sunk. For the week, it's down about 11%. But from the recent highs, 10 days back, stock was 350 and it's at about 280 rupees now. I'm assuming it's earnings-related reaction. We'll check up and get back. But there's a fair bit of sort of price damage which is happening in mid-caps and small caps out there.
Even where you had good numbers, like Vishal Mega Marts, opened 4-5% higher. Now it's completely flat. Jubilant Foodworks is flat. United Spirits is on the verge of breaking into the red. Well, get into a break on that note. On the other side is our special segment. It's the economy. Lata discusses with economists Aditi Nair and Bandhan fixed income head Suyash Chaudhary if Indian bonds are crashing because of fiscal deficit fears.
Greetings to everyone for Independence Day. I'm going to do some straight talking today for the good of the country. The bond market is broken. Earlier this week, even a small state loan auction struggled to find buyers because banks simply don't want to buy. They're sitting on losses. The 10-year GSEC yield is at 6.5%, up nearly 35 basis points from, the early June levels. It went to 6.17. It's almost as if there has been a rate hike. The first cause of the bearishness is a feeling that the rate cut cycle has ended. The stance has changed. A second reason is the fear that tax collections are going to be seriously disappointing, and hence there may be fiscal slippage, maybe more bond issuance by the government in the second half. To discuss the plight of the fisc and the plight of the bond markets, I have with me Suyash Chaudhary, the head of fixed income at Bandhan AMC, and Aditi Nair, the chief economist at ICRA, an expert on the fisc. So Aditi and Suyash, thank you very much for joining me, and my greetings for Independence Day. But let me start with you, Suyash, because the bond market is in such a state. What do you think is dragged the bond markets into such a sulk?
So, Lata, we think there are two aspects at play. One is that the bond market has taken time to figure out the revised approach of monetary policy. So, as you know, monetary policy this year has been very focused on ensuring transmission right away in the most broad-based manner possible. And for that reason, they have upfronted a rate cut and liquidity injection. So for the first phase of this period, the bond market's expectations were almost over-delivered by the central bank. And then in order to signal to the market and economic agents generally that monetary policy should not be relied upon as the only game in town, the stance was changed in the June policy, and subsequently the tone of policy has been interpreted as being slightly hawkish. So there has been a bit of an expectation shock to the bond market from perceiving a central bank who was very focused on monetary easing to suddenly a change of stance and communication. Yeah. So in some manner, you can say that the expectation channel of the bond market for the time being has been neutralized. So that is one aspect leading to a belief that, the next move, whenever can potentially be a hike, although our sense is that we are still in the middle of the slowdown cycle, both globally and locally. And any sort of a rate hike is actually miles away. In fact, you cannot even rule out further rate cuts from the central bank. So this is first piece. Second is that, as we know and is well established, duration supply from central government bonds has gone up substantially over the last couple of years. In the first phase, there was pension and insurance demand to absorb this excess duration. But in this phase, that demand has been lacking. And yet the supply calendar has not, at least till date, been tweaked. There is one additional development. For whatever reason, this financial year, the average duration supplied by states also has picked up meaningfully. Oh. So now you're seeing, a market which is somewhat scratching its head with respect to future direction of monetary policy, at the same time being called upon to take on duration supply that it clearly does not want. So the need of the hour is probably a bit more, dynamic reassessment of how much duration can be supplied to the market and in what form.
Got it. Just a word for our viewers. When Suyash says duration supply, he means longer term bonds. Perhaps state governments and central government should be borrowing more 10-year and below or 15-year and below, and not 40-year as they have been doing. That's the ask of the bond market, as Suyash puts it. But Aditi, let's look at the fisc. I mean, we discussed enough about the rate cuts and rate cycle. We'll come to that if time permitting. But is the fisc going to face a situation where it may have to issue more bonds, or the fiscal deficit has to be higher? Because the tax collections, corporate and income tax, although, the first returns we will know only in August, the date has been extended, but still it is abysmal. Tax collections are flat year on year. And there is an expectation that a package should be given to the exporters who are suffering. So is it a real fear that the fiscal deficit may be higher?
Thanks, Lata. So let me start with a couple of factors that are giving the fisc some amount of buffer this year, and then I'll go into how we are assessing the tax collections. So first of all, we talked a little bit about this earlier this week on the nominal GDP side. I'm going to start with that. That's the denominator. We're going to assume that Government of India is going to try and keep its fiscal deficit at 4.4% of GDP, which is what the budget estimate for this year was. So the nominal GDP itself for last year ended up being higher than what had been penciled into the budget. So that's for FY25. For FY26, we're all now working with nominal GDP growth that's probably going to be just about 8 to 8.5%. But even with such a moderate nominal GDP growth, the nominal GDP denominator or base for FY26 will still be a little bit higher than what the budget for FY26 had penciled in. So a tiny amount of buffer coming in from that, about 15 to 20,000 crore is what we're assuming is the leeway that we have. Secondly, on the non-tax collections, particularly the RBI dividend, that's giving us some more buffer as well. So 50,000 crore, I would say, between the nominal GDP, RBI dividend, and the fact that at least right now, the disinvestment situation is looking much better than what it typically does at this point in time. So at least we're not looking at a slippage the way that we're usually a little worried that there might be a bit of a slippage from disinvestment.
Got it.
I would say that today we're sitting on a better position than that. So 50,000 crore is a buffer to either absorb lower tax revenues or to increase expenditure or a combination thereof.
Aren't taxes much lower than expected?
So Lata, I would reserve my assessment of how bad the situation is at least until we see the September quarter data. The first quarter tends to be the smallest quarter for tax collections. Normally. And here, if there is a base effect, then the numbers look quite awry very easily. Okay. It doesn't take a lot for the numbers to look very strange. There do seem to be a lot of refunds. And of course, the filing deadline is also extended this year. So I do think we'll be in a much better position to actually assess the tax situation by the middle of September. Okay. And I'll tell you what Q I'll be looking for. Whether we get a double tranche of tax devolution to the states in September or not. If we do, then I think we should assume that things are okay. If we don't, maybe that will be the first signal that we should be looking at tax collections being weak.
Okay. As it is, the income tax assumption in the budget was about 15% or so. And last year we fell short as of March 31st by a bit. So the lower base makes the tax expectation or assumption even higher, which is, I'm finding it difficult to believe that we will be able to reach that kind of taxes, in which case the buffer will be absorbed. So Yash, is there a genuine fear of even higher issuance, or is the bond market now only worried about the combination? That is, we don't want more longer term paper, please sell more short term paper. Is that the only worry, or is more issuance itself a worry?
Lata, I think the dominant effect is confusion with respect to the future of monetary policy, as well as the higher duration. And bear in mind, duration is not just the long end, but even, for example, the 15-year segment is starting to show the pressure. So the need of the hour is really to hike, issuances in the 5-year odd segment, where, balance sheets will be more in a position to buy given very low funding rates today. Okay. I think, nobody seriously expects any very proactive expansion in the fiscal deficit as a response to a slowdown. Okay. Some expansion owing to a shortfall because of nominal growth slowing is, well par for the course. And I think the bond market will accept that. Okay. It needn't even translate into more dated GSEC borrowing. It could very well be funded by some amount of treasury or other sources if required. So I won't say, that is a fear that is as yet a big portion of the bond market sell-off. Okay.
So let me squeeze in the other problem which I think the bond market is facing, the quality of buyers and sellers. Last year, we had good buying by the insurance companies and we had that bond inclusion. So the FPIs were buying. Those two are absent now, and banks are also absent because, there has been a change of rules on how you account for HTM, held to maturity. So do you think three buyers are absent now? FPIs are absent, insurance is not buying much, bankers are not buying much.
Absolutely. In fact, sometimes we joke that it will be a better thing if part of the government borrowing could be done as corporate loans from banks, because, everyone is wanting to do more loans. Pricing there is much more aggressive, and yet mark-to-market risk, as you suggest, appetite for that has diminished substantially. There are ways around. It's just that transmission from the bond market also needs to be on the radar of the central bank, because clearly this massive widening in term spreads without a fiscal stress in sight is something that is at least impeding transmission via the bond financing market, and it should be part of what central bank watches, we hope.
I agree with you. And let's see. Insurance companies have also clearly let down the bond market. But Aditi, can there be a reigniting of hope of a rate cut? If not for inflation reasons, because the RBI keeps looking at 12-month forward and saying that it is a 4%. You may squabble whether it is 4.9 or 4.5, but either ways it is above their comfort zone. But can there be a growth reason to cut rates?
Well, as of now, we think the growth reason to cut rates will take quite a bit of time to really manifest. When we spoke earlier this week, we discussed our views on the GDP growth for Q1. We're penciling in a 6.7% GDP expansion in Q1. And we fear that that's going to be the highest quarterly print for this fiscal year, because a lot of the growth impulses have been upfronted in a sense. We've had very high capex from the center in the states. We've had upfronting of exports to some geographies as well. So these drivers of growth are likely to taper off as the year continues. But you will end up with growth prints that are possibly going to be sub 6% by Q3 or Q4. And even the high frequency indicators may only start showing that stress much later in the year. So inflation uptrend is going to give you bad optics for a rate cut, and the growth optics for a rate cut will also be quite back-ended. My baseline expectation is that we're now in an extended pause scenario. I'm not sure we can count on a rate cut.
Okay. Yeah, by the time you get to know that the third quarter GDP is, sub 6 or maybe just about 6%, it is going to be February. So will we get a December rate cut is a bit of a question mark. February, perhaps we can expect. Suyash, to wind down the conversation, what is your ask? If you have to ask the governor something or the finance minister something, what does the bond market want?
So first is to restore the expectation channel for transmission. See, nobody is really asking for meaningful further rate cuts. It's just that, the slowing economic cycle, both globally and locally, still has some room to run. Whereas, commentary almost suggests that this is the end, or at least that's how the bond market has interpreted it.
Yes.
The first task is to, basically try and restore the expectation channel that we are still in the middle of a particular phase of the economic cycle. And, that obviously will have support from the central bank. To be fair to them, they have been hinting in that direction, but probably the bond market wants a little more clarity. Second is a bit more, active duration management of supply, or, the tenure of bonds that are supplied to the marketplace, given that India doesn't really run any meaningful refinancing risk. Most of what is borrowed locally. We are running a current account deficit, which is 1% of GDP.
Or even less.
So, we don't really have any meaningful refinancing risk. We are a solid macroeconomic story where hopefully structurally bond yields will be lower. And therefore, even, some bit of interest cost saving can happen for the government if duration management of supply is done a little more proactively basis demand from the market.
Got it. Thank you very much for putting it so succinctly, Aditi and Suyash. Have a great year ahead, and let's hope this Independence Day, we will be rewarded in the days and weeks to come with some more clement policy for the bond markets. Thanks so much for joining us. Time for a break. Chartbusters up next.